Okay, you said you entered at what price?
1.09585.
1.09585. Date?
Sir?
Date. 1.09585.
1.09585,
The
yes.
date.
Date?
Yes.
That was on the 14th. Sorry, on the 9th. On the 9th.
9 should be Tuesday, right? Please confirm.
No?
Monday or Tuesday? 9th.
Yes.
That should be Wednesday.
Wednesday.
Wednesday. And a major news was released on Wednesday, right? FOMC, 7 p.m.
Mm.
Right? So you entered at this point,
Yes, sir.
1.0958. Let me go down to 4 hour. Okay. So you said that was on Wednesday, right?
Uh,
Wednesday. Okay. This is Monday, Tuesday, Wednesday. So let's go down to 4 hour. So for Wednesday, we had 1, 2, 3, 4, 5, 6. I think this is the first candle for Wednesday. Okay, so these are the 6 candles that formed on Wednesday. So why did you execute a buy trade?
sorry?
Why did you execute a buy trade? What's the reason for the buy?
Okay. The reason for the buy was there was, if we check on a higher time frame,
What time frame? I'm on 4 hour
um,
now. I started from daily. This is the daily. Okay, this is Wednesday candle.
yeah.
Okay.
So if you check this this uh, Friday, Thursday, Wednesday. If you check this Wednesday candlestick, it closes as I think bullish reversal pattern
On Tuesday or Monday.
on Wednesday, Tuesday.
Okay, we had on Monday looks, this is a spinning bottom, right? Bullish spinning
Yeah,
bottom. And
yeah,
Tuesday also closed as a bullish reversal pattern. This is also a
reversal pattern.
spinning bottom,
Yeah,
right? So
yeah.
on Wednesday, you decided to buy at this price, 1.0958. So let's go down to 4 hour. What other thing
Okay.
did you look at for? What other confluences did you
Um,
look
I think
for
there was
executing the trade?
also a fair value gap that was filled. There was a fair value gap that was filled, I
On
think,
what time frame? Because
on
I can't find the fair value gap here. I can't find the
I'm
fair value gap here on 4 hour time frame. Let me go down to 1 hour time frame. Let's see.
think it should be on either 15 minutes or thereabouts.
On 1 hour also, I can't find fair value gap here on 1 hour. No fair value gap here. Let's go to 15 minutes. Probably after the formation of this candle, probably a fair value gap was created. So let's go down to 15 minutes. So this is 15 minutes. So which of the fair value gap did you work with? This fair value gap?
Which one? Yes, I think that should
It
be.
can't be this. It can't be
No,
this
no,
because your
no.
entry was at this point.
It
So it
wasn't
can't
that
be
one.
this. Yeah,
There
it
is
can't
still,
be this.
I
So let's
think
go back. Let's
there
go
is a
back.
fair value gap. Yeah, I think it should be around
I think
this
this one,
period.
let's see.
Yeah.
Let's see this fair value gap. So we'll see the candlestick pattern that formed and price fill the gap. So let's go forward. Let's see. So you took a buy, right? At this
Yeah.
point,
Yes, sir.
because you felt that fair value gap got
Was
filled.
filled.
That's it. That's not enough confirmation, right? That's not enough confirmation. You should have waited for a shift in market structure. There was no shift in market structure on 15 minutes or 1 minute time frame or 5 minutes time frame. You can see why the trade went against you.
Yeah.
There was no shift in market structure. Please mute your mic, please. There was no shift in market structure. Okay, that is the reason the markets didn't go in your direction, and it could also be fundamentals. The reason could also be fundamentals. Are you getting me?
Yes, sir.
But if you had waited for a shift in market structure, I believe you wouldn't have taken this trade, right? You wouldn't have executed the trade because a shift in market structure would have occurred. Probably you would have waited for price to break.
Which was this, sir?
Are you asking a question?
Yes, I'm asking what pair are we considering, sir? What pair?
We are on Euro USD. We're doing a review, okay, on a trade that was executed last week. Okay, so the trade went against you, right? It was a loss.
Yes.
So
Yes,
we're kind
sir.
of trying to find out the reason why the trade didn't go in this direction. Okay, and we just noticed that there was no shift in market structure on the lower time frame. Before you execute a trade, you must ensure that there is a shift in market structure on 15 minutes or 5 minutes time frame. It could even be 1 minute time frame, depends on how volatile the market is. Okay, you could work with 1 minute shift in market structure. Are you getting me? It depends on how volatile the market is. So in this case, there was no shift in market structure before the trade was executed. Okay, so that's the error on this trade. And we also are aware that a news was released on Wednesday. That was FOMC, 7 p.m. Okay,
Yeah.
news was released 7 p.m. and that also had a major impact on Euro USD. Okay, so that could also be the reason for the loss. Okay, so next time. So the first thing you did, identify the candlestick pattern on the higher time frame. You could, if you are a day trader, identify the candlestick pattern on a daily time frame after the close of the market for the day. If the pattern is a bullish or bearish reversal pattern, you go down to 4 hour. 4 hour is your medium time frame. Now, the pattern you find on 4 hour must align or agree with the pattern on the daily time frame. So if the pattern is bullish reversal on daily, on 4 hour also, you should be able to identify a bullish reversal pattern. Those two time frames must be in agreement. Then you go to 1 hour or 15 minutes time frame to identify shifts in market structure. 15 minutes time frame. If you're working with 4 hour, you can, daily 4 hour, then go to 1 hour. Okay, you sometimes ignore 1 hour time frame and work with 15 minutes time frame. Are you getting me? Identify your shift in market structure on 15 minutes time frame. If you're working with daily as your higher time frame or 4 hour as your higher time frame, use 15 minutes as the lower time frame, and that is where you identify the shift in market structure.
What about
I hope that is clear.
What about fair value gap?
Gap will be filled before shift in market structure, right? Gap will be filled before shift in market structure. Also identify shift in market structure on 15 minutes or 5 minutes time frame. Okay, 15 minutes or 5 minutes time frame. Sometimes you could also identify shifting fair value gaps on 1 minute time frame. Okay, so let's say you're working with 4 hour as your higher time frame. You go down to 15 minutes, identify the most recent lower high, right? That's where the shifting market structure will occur. Identify the most recent lower high on 15 minutes time frame. Also identify the fair value gap on 15 minutes. Go down to 5 minutes. Identify fair value gaps on 5 minutes. Also go down to 1 minute. Identify the fair value gap on 1 minute time frame. The reason for identifying those fair value gaps on those time frame is to know where to set your stop loss. Your stop loss must be below all the fair value gaps. If you just identify 15 minutes fair value gap, you can decide to set your stop loss below 15 minutes, the fair value gap on 15 minutes, but price might break the 15 minutes fair value gap and aim for 5 minutes fair value gap or 1 minute fair value gap. So you need to identify all those fair value gap and ensure that your stop loss is below all the fair value gaps. I hope that is clear.
Okay.
I hope that is clear. Any question? Mr. Evans, I hope that is clear. Any question? If you have any question, you can just unmute your mic. Is that clear?
Yes, sir.
All right.
Yes. Yeah. Good evening.
Any other question? Any other question? Or we just start our weekly market review? You start the class,
Yeah.
right?
Yeah.
Okay, so let's start with Euro USD. As you can see, I'm prepared for next week. You see my GBP USD. I've done my analysis. This is it. I've done my analysis on GBP USD. Okay, so I'll be opening new charts for today's class. I don't want to delete this stuff that I've done on my chart. So you can see I'm expecting price to pull back to this area before going bullish on GBP USD. Also on Euro Australian dollar, you can see I've done my analysis. I am bearish on Euro Australian dollar, but I want to see price pull back to this area before I would sell. I'm prepared for next week. Okay, so here also I want to see price pull back. I have a trade on AUD USD, which is a buy in profit, but I still want to see price pull back. There's a high probability price will pull back to this area before going bullish next week. Okay, so let's see Euro USD. I'm set for next week. Euro USD. Let's start with the weekly. Okay, so what can we see on the weekly time frame? This was the resistance level, right? That was the resistance level. We also had this resistance level. So this is like a demand zone. So price tested this demand zone last week. And you can see there's rejection from that zone. You can see that there was a rejection from that zone. And last week candle closed as an indecision candle. This is a spinning bottom, which indicates change in trend from bearish to bullish, right? So now if you're just focused on the weekly time frame, if you're a swing trader, you're supposed to wait for the coming week candle to close bullish. Your trading candlestick pattern after the formation of a bullish reversal pattern. This is a bullish reversal pattern, but the body is bearish. You have to wait for the next candle to close bullish before you buy. So if you just focus on the weekly time frame, probably you're a swing trader, you have to wait for this coming week candle to close bullish. So if this coming week candle closes bullish, it will be a confirmation that the upper week would be bullish. Okay, so after the formation of this bullish reversal pattern, on Euro USD weekly. Let's go down to daily. If you are able to identify a bullish reversal pattern also on daily, then we should go bullish on EU this coming week. Technically, EU would be bullish. So let's go down to daily to identify the candlestick pattern that formed. So you can see also daily, what we have here is a bullish reversal pattern, right? This is a bullish reversal pattern. It's a bearish, the body is bearish. So we have to wait for this next candle to close bullish, right? And this candle closed bearish. This was Friday candle, this was Thursday. You can see, so the next candle, which was Friday, closed bearish. So for us to buy Euro USD, a bullish candle must close after these two candlestick patterns because the bodies are bearish. This indicates that we still have few sellers. We still have few traders who are still willing to sell Euro USD. And since we are considering buying, we have to wait for a bullish candle to form before we execute a trade. We can't execute a buy trade when the candles that are printing on the chart are bearish candles. It will be wrong to execute a buy trade. Okay, so we have to wait for a bullish candle, and that will be on Monday, right? We have to wait for Monday candle to close bullish before we buy. But if we don't want to wait for Monday candle to close, what do? We go down to the next lower time frame. Now let's go back to weekly. There's something I want us to notice here on the weekly time frame. Or was it on daily? Okay, let's go to daily. I think it was on daily. Okay, now on daily, I want you to notice this. On daily, we have a fair value gap here that has not been filled. So there is a high probability that they might want to push price to this area. Okay, they might want to fill this fair value gap before going bullish. Also, this low, as you know, it's an area of liquidity. A lot of retail traders would have executed buy after the formation of this candle. And where would they have their stop losses? Their stop losses would be below low of this candle or the low of this candle. So there's a high probability that on Monday, they will push price down to this area to clear liquidity. And if they are able to clear liquidity reside at this low, there's a high probability they will fill this gap before going bullish. Are you with me? There is a high probability that if they're able to push price below the low of this candle, they would fill this fair value gap. Now, the candlestick pattern that formed after liquidity has been cleared or this gap gets filled would determine if one can go bullish. The candlestick pattern. A bullish reversal pattern must form after liquidity has been cleared or this fair value gap gets filled. That is what will determine. So if they clear this liquidity and the candle is still strongly bearish, it means that we have to wait for price to fill this gap. And if after filling this gap, the candlestick that's still formed is still strongly bearish, then it means price is likely going to keep going down. We have to wait for a valid bullish reversal pattern to form before we buy. You have to wait for the right time, the right setup before you execute the trade.
Okay.
I hope you're following. Okay, so so after this is daily time frame, let's go to 4 hours. So we've identified the candlestick pattern on daily, on weekly. Let's see what we have on 4 hour. What do we have on 4 hour? Okay, so you can see on 4 hour, what pattern is this? This is a bullish reversal pattern. This is an hammer on 4 hour time frame, right? This is an hammer. So daily, 4 hour, weekly, we're able to identify a bullish reversal pattern. Now, before we buy, there has to be a shift in market structure on 1 hour or 15 minutes time frame. So on 1 hour, where would the shift in market structure occur? think this is the most recent lower high. Okay, this is the most, I think, yeah. Am I correct? Yeah, that should be the most recent lower high because this was the high that was used to clear the liquidity that was residing at this previous low. And also it was used to clear the liquidity residing at this previous low. So this is the most recent lower high.
Okay.
And see that. So if a candle closes above this high, you might want to consider buying. Are you getting me? So those are the two scenarios that is likely going to play out next week. It's either price goes up, continue going up from this point, close above this most recent lower high. That would be a shift in market structure. You might want to consider buying. Now, if you are buying from this point, if you decide you want to buy from this point, the next thing you need to consider before you buy is the risk. Okay, you need to calculate the risk and ensure that the risk is within your risk parameter. Ensure that you are comfortable with the risk. So let's assume the candle closes at this price and we decide to buy. Our stop loss will be, let's say, a few pips below this level. So we'll be risking close to 65 pips on this trade. Personally, I don't like taking risk above 50 pips currency pairs. So for me, entering a buy at this price is not a good entry. Going by my trading rules, okay, it won't be a good entry. So I'll prefer price to pull back. Okay, I think a favor lookup was created. Let's see, after the close of this candle, let's see, 15 minutes. Okay, good. There's a favor lookup here. 15 minutes. So I would like to see price pull back to this area before going bullish. Are you with me? I would like to see price pull back to this area. If I apply my Fibonacci from this swing high to this swing low, so you can see where we have the fair value gap. This is the discount. So I want to see price pull back to this area, fill this gap, and after price fills this gap, a bullish reversal pattern should form inside this gap. A bullish reversal pattern must form inside this gap for me to buy Euro USD. Now, I could buy from this point. Now, I'm supposed to sell my stop loss maybe a few pips below this level. So that's about 20 pips. Okay, it's about 20 pips. But you know what I will use as stop loss? This is what I'm going to use as my stop loss initially. So let's assume the candle closes above this level. I decide to buy. What is the risk from this point to this point? This is about 54 pips. Okay, this is about 54 pips. So if I'm to wait for price to break this high before buying, which would have been the right place to buy, I would have set my stop loss 50 pips below this level. That's about 55 pips. So if price pulls back to this area, I'm not going to set my stop loss here. Okay, I will still use 50 pips, which is far below this level. 50 pips. I'll still use 50 pips as my stop loss, which is far below, right? Far below this level. Okay, now if price breaks this high, if price, let's say I buy from this point and price breaks this high, by this time I would have made, I'll be in profit of, let's say, 40 pips, right? I'll be in profit of, say, 40 pips. Okay, so it is after price breaks this high, I will adjust my stop loss probably to maybe 10 pips below this level. So my risk will reduce to 20 or 25 pips. Are you guys getting me? Are you guys getting me?
Yes,
Mr. Evans.
yes. Yes, sir.
Mr. Joseph. I hope you're getting me.
Yes.
Especially when the major news is being expected. I don't want to set my stop loss here because I know this is an area of liquidity. And I don't want to set it 10 pips below this level because I know if a major news is released, there's a high probability they will come for the stop losses and still push price far below this level. So I'm going to assume I'm taking the trade, I'm executing the trade from this point. Okay. I'm going to assume that I'm executing the trade at this point. Now, after price breaks this high, okay, after price breaks this high and my stop loss has been adjusted to this level, I have made a profit of 40 pips on this trade. I'm going to add more trades. Are you with me? I'm going to add more trades. Are you getting me? Now, if I had more trades here, remember I've reduced my risk on this trade. So I would have money, right, to trade. Let's say the risk I want to take on this trade is $50. Okay, let's say I want to trade with 0.1. I use 0.1 on the first trade. Okay, let's say I use 0.1 on the first trade. So the risk is $50, right? And that's what I'm willing to risk on the trade, $50. Now, by the time price breaks this high, I would have made $40. So the only risk on the trade now will be like $10, right?
Yes.
Let's say $15, right? Let's say $15. The risk will be $15. 15 minus $50. I'll be left with $35, right?
Risk.
So on the second trade, the lot size I would use, the risk I would take on the trade must not exceed that $35. And now if I'm taking the trade from this point, stop loss is now at this level. So my risk will be 25 pips. So what lot size would give me $35 loss? What lot size? 50 pips. That should be 0.06. Yeah. 0.06 will be $31. Are you getting me? So by the time if the trade goes against me, I lose both trade. My loss will not exceed $50. Are you guys getting my logic?
Yes.
Okay. So that is it for Euro USD. I'm going bullish on Euro USD next week. On Monday, there's no major news. I've checked the calendar. On Tuesday, there's a major news for GBP. So I'll be trading GBP pairs on Tuesday because there's a major news for GBP. So on Tuesday, I'm likely going to be trading GBPUSD. I think the news is for 10 a.m. or 11 a.m. Okay, so I'll be trading GBP because there's a major news. Monday, no major news. It means there won't be much volatility in the market on Monday. There won't be much volatility on Monday. So my plan is to avoid trading on Monday. Okay, and if at all I see a good setup, I will trade. I will go in with less risk. Let's say 50%. So if I'm supposed to trade with 0.1, I'll trade with 0.05 lot size. Are you getting me? If I see a very good setup, the setup must be an A setup. And that's when I'll trade. Or if the setup is a B or C setup, I will ignore trading on Monday. I won't execute a trade on Monday. I hope that is clear. So that's my take on Euro USD. I want to see price pull back, fill this value gap we identified on 15 minutes time frame before going bullish. I hope that is clear. Now, if I also decide to buy after price breaks this high, okay, if I decide to buy from this high, I'm going to go in with 50% of my daily drawdown, which will be $50. So 50%, that will be $25. So if I set my stop loss here, I don't want to risk more than $50 on this trade. So let's say my stop loss would be here. That's 60 pips. So what lot size would I apply on this trade? $25. That should be 0.04. Yeah. 0.04 times 60. That will give me $24 loss. So my stop loss will be here. Okay, so I'll risk $25. Now, if price pulls back after a shift in market structure. If price pulls back to this area, I will execute another trade with the remaining $25. So if price pulls back to this area, let's assume I take the trade from this point and my stop loss, let's say at this level. So the risk here will be 20 on the second trade, and I still have $25 left. It means on this second trade, I can apply 0.1 lot size, right? It means I can apply 0.5 lot size, right?
Yeah.
Okay, so that is my plan for next week. Okay, that's my plan for next week. Price breaks this high, I will go in with 50%, pulls back to this area, add more trade, and hope that it goes in my direction. But I would ensure that I don't lose more than my daily drawdown. Are you getting me?
Yes, sir.
Everything has to be planned. Okay, everything has to be planned. You don't just open your chart and start executing trade. You have to plan it. Everything is planned. Okay?
Yes.
So that's my take on
EU.
EU. Which other pair do you want us to look at?
USDJPY.
USDJPY, okay. USDJPY. Okay, someone said we should look at gold. Okay, we'll look at gold too. Let's look at USDJPY. I'm done with this. Let me delete. Mr. Joseph, are you still with us?
Yes, boss, I'm there.
Okay, so let's look at USDJPY. USDJPY is still bullish. USDJPY is still bullish. Let's start with the weekly. It is still bullish. Okay, 2 weeks ago, markets broke out from this resistance. You can see 2 weeks ago. Last week also traded above this resistance. Okay, so it is still bullish. Let's go down to daily. You can see what's the reason for the pullback. That was on Thursday. Price tested this resistance. Okay, price tested this resistance, and that was the reason for this pullback. So if price breaks this resistance, expect more bullish move on UJ. But I want UJ to pull back. That's my expectation. I want to see it pull back. There's a fair value gap here, but I doubt if it will be able to drop to this area. Okay, let's see the difference from this point. About 383 pips. I doubt if it will pull back to that area. I doubt. Let's see what we have on 4 hour. Let me see. We apply trend line from this low. Still bullish. Let me see daily. UJ is bullish. Is bullish, but you should wait for a pullback. Okay, we have this here on 4 hour. So we can work with this fair value gap. Okay, we can work with this. So I'm expecting UJ to pull back to this area, probably come and hit this level before going bullish. But the probability is very slim. It's very slim. Probability is very low, very low. Okay. So I just keep going up. Let's see. UJ is not set for sell. Okay, UJ is not set for sell. It's likely going to come clear this high next week. Okay, my bias for UJ this coming week is it's buy. Okay.
Yeah,
It's buy.
okay.
It's buy. Or if you want to buy, wait for price to pull back.
Back.
Okay, and wait for a pullback before you buy. Buying at this at the current market price is very risky. The risk is high. Yeah, Mr. Joseph.
Hello, Bob. Yeah.
Yeah, I can hear you.
I think we had something like a kind of a double top on the previous time frame that you just said. Was it daily or weekly?
You mean this?
Yes.
This is a double top.
Uh-huh. So is this weekly? This weekly time frame?
This is daily time frame.
Okay, daily time frame.
So when you say double top, think like a retail trader executes as an institutional trader.
Okay.
So what will retail traders do in this case?
They sell.
We'll scale
Retail
down to the
traders will
lower
sell.
the next time.
Retail
We'll
traders
go
will
to the
sell.
next time.
Yes.
Hello,
Hello,
sir. We'll scale down to the next time frame.
This is
So what can you see here?
You have to zoom out a little bit. Let's see.
This is H4. If you apply, let's just say you apply your trend line. This is H4, right?
yes.
Okay.
Yeah, this is H4. Let me just show you something. So if you apply your trend line, let's just use trend line here. It's from this high, let's drag it down. And you see this. This trend line has been broken, right?
Mm-hmm.
And with this shift in market structure, I think has occurred. This is the most recent lower high. Okay, this is at this point, shift in market structure will occur on 4-hour time frame. This is the most recent lower high, right?
Yes, sir.
Why not this?
Because that high,
Why this and not this?
it was used to clear liquidity.
This high, right?
Yes.
Yes, this high was used to clear this liquidity residing at this previous low. So on 4-hour, this is where shift in market structure would occur. And I think last week, I think the market closed above that area. I just tested that area. Let's see. This is it. So let's see. Okay, just tested that area. It has not broken that high. It has not broken it. So that's what is holding price now. You can see that. That's what is holding price. Okay. So like I said, price is likely going to pull back or just break out from these highs and just keep going up. So on Monday, we'll get to know the right direction. The close of Monday would give us the direction. Okay.
Okay.
So that's my take on UJ. UJ is still bullish, but don't buy from the current market price, please. Wait for a pullback before you buy. If there is no pullback, don't buy USDJPY. You had several opportunities to have entered by. This is the first opportunity. If you had missed this opportunity, there was a pullback at this point. If you had missed this opportunity, you had another opportunity after this pullback, right? So first opportunity, you missed it. Second opportunity, you missed it. Third opportunity, you missed it. So why would you want to buy from this price? At this price now, a lot of people bought from this point. They've made so much profit and they would want to sell to take their profit from the market. So if you enter at this price, there's a high probability they will go for your stop loss, unless you want to set your stop loss at this point. Okay, so this is not good price. Like I told you guys, when you open your charts, you want to know where price is coming from, where price started going up or started going bearish. You want to identify the levels, look at where price is at the moment. Is it far from where you ought to have entered the trade? If yes, you have to wait for price to pull back or just let go that trade. Wait for a good opportunity, another opportunity to execute a trade. Don't jump in because you have missed the opportunity because of FOMO. Don't jump in. There will always be another opportunity for you to catch the trend and make good profit. Okay, so patiently wait for the right time, wait for your setup before executing the trade. So that's my take on USDJPY. So let's look at gold. I hope that is clear for you, Jay.
Yes.
Let's look at gold. Gold is still bullish too. Gold is still bullish. It is still bullish. So on the weekly, what do we have here? This is a spinning top. I was expecting this move last week, this bearish move. After the formation of this spinning top, I was expecting this move last week, this bearish move. But I was looking for buy opportunity last week. So I was waiting for price to pull back, okay, before going bullish on gold. So let's see what we have on the daily. So you can see what we have here. This is an engulfing pattern. There was a fair value gap at this point. I think they filled that fair value gap. Not entirely. They came, tested this fair value gap, and there was a rejection from that area. You can see. So we have an engulfing pattern here. So on Friday, that would have been the right time to buy gold. Friday. Okay. One would have entered buy on gold. We have made close to 300 pips on gold. The movement was just too fast. I missed it. The movement was just too fast. I missed it. So this is an engulfing. Let's go to 4 hour. Okay, so if you want to trade gold next week, my bias for gold is bullish. Okay, my bias for gold is bullish, but I can't buy gold from the current market price. For me to buy gold, gold needs to pull back to a discount area. I can't buy gold at the current market price. So I would apply my Fibonacci to from this swing low to this swing high. If gold does not pull back to discount, I wouldn't be trading gold. I would not buy gold. It has to pull back to a discount area. Okay, so that's my take up for gold next week. Gold is bullish next week, but price must pull back for us to buy gold. It has to pull back. Now, if we go by what we have on 4 hour time frame, go by what we have here on 4 hour time frame, this is a bearish reversal pattern. Okay, it might not be clear on 4 hour, but if you go to 1 hour and 15 minutes, we'll be able to identify, you can see bearish reversal pattern on 1 hour. You can see. So this pattern is likely going to play out before gold will go bullish. So after this pattern, let's go to 15 minutes. There has to be a shift in market structure on 15 minutes if you want to sell it. And the shift in market structure on 15 minutes, I think, would occur if you work with this low or this low. Okay. Work with this low, hit this low, shifting market structure should occur here. So price needs to break this low if you want to sell. But consider the risk here. The risk is very high. It's very high. Oh, wow, this is about 250 something pips. Very, let's say 5 minutes. The risk is very high. Selling from this point. So just look out for buy opportunity. That's what I would advise. Look for a valid buy setup on gold. Wait for price to pull back. Okay? Before you buy gold. I hope that is clear, Mr. Jesuto, for me. I hope that is clear.
So
I hope that is clear.
yeah, hello boss.
Yeah.
Like you said now, you said if we are to sell good, we have to wait for a shift in market structure on the lower time frame before we consider selling. Now, considering the risk that is involved now, we have seen that the risk is very high. So that's to say we don't need to wait for the shift in market structure to occur now. Sorry?
It means that you should ignore the trade.
We should ignore the trade.
Since the risk is too high.
Yeah.
Ignore the trade. Or if you want to take risk, okay, if you are aggressive, you can go to, let's see, 1 minute.
It's like you are far from your mic, it's faint.
How is it now? Is it better now?
A little bit. Can't even hear you again.
How is it now? Is it better?
It's a little bit. Take it closer a little.
How is it at your end, Mr. Jesu Tefumi and Mr. Evans? Is it clear? Am I audible?
Yes, not too audible, but we can manage to hear you.
To be the cause. But it was audible before, right? The sound was okay before.
I think it's the network, but go ahead.
Okay, I think it's the network. Okay, so you wanted to ask a question. You were saying something, Mr. Joseph.
Yeah, I said since the risk is high.
Let's see 1 minute. Let's see what we have on 1 minute. You know, this is pullback. This sell is a pullback. We're trading against the trend. Right? It's a pullback. We're trading against the trend.
The pullback for the uptrend continuation.
Yes. What's happening here? Okay. So this is what is it called? 1 minute sign frame. Let me use this too. Okay, so on 15 minutes is the most recent lower high. Sorry, higher low. So if we wait for price to come to this area before we sell, 264. Let's go down to 5 minutes. Let's see if we can identify the recent higher low. Let's see. 5 minutes. This will be the most recent lower higher low. If we decide to wait for price to get to this area before, this is about 210 pips. The risk is still very high. Now, if price breaks this low or this low, you should wait for price to pull back to a premium area. That's what you should do. Don't jump in and sell at this point or at this point because the risk is too high. So you have to wait for what happened. What happened? How is it now? How is the sound now? Is this better?
Yes.
This is better.
Yes.
Okay. So so you wait for price to pull back if you want to work with this higher low or this one. When price breaks this level, wait for price, apply your Fibonacci, wait for price to pull back to premium before you sell. I hope you get that. Okay, let's go. Let's see 1 minute. So on 1 minute, this is the most recent higher low. Okay, you can work with this. This is the most recent. Let's work with this. And you can see the shift in market structure on 1 minute. Shift in market structure has occurred on 1 minute time frame. You can see that. So one can sell gold from the current market price. But let's see the risk involved here. You're selling from this point. This is about 64 pips. So you can set your stop loss maybe 20, 40 pips above this level. So if I'm going to take sell trade on gold from this point, my stop loss will be several pips above this level. Okay. So you could also wait for price to pull back to this area. You can see this area that I identified. You could wait for price to pull back to this area before you sell. Okay, you could wait for price, but the risk here is not much. This is 64, just use like 80, 90 pips, and your TP will be that 5 minutes recent higher low, the 5 minutes or the 15 minutes. So let's assume you take a set from this point. That's why you should be concerned about the risk reward. So let's assume price will drop. We'll come for this higher low on 15 minutes. Let's assume price will come there. So if you sell from this point, you are risking, let's say 90 pips, and your reward is, the risk reward makes sense, about 200. So that's like 1 to 2 point something risk reward. Why some people are waiting for price to drop to this level before they sell? You could jump in here, okay, and set your stop loss few pips above this high. Are you getting me? So one can actually take a sell going by 1 minute shift in market structure on 1 minute time frame. One can actually take a sell here. Okay, then your first TP should be this level. Once the market moves in your direction 100 pips, you can adjust your stop loss, bring it down to this high. Okay, so your risk will be like 60 pips. After the market has moved in your direction 100 pips, you reduce your risk on that trade, adjust your stop loss, bring it to this high, the high of this candle. I hope that is clear, Mr. Joseph. Mr. Joseph, I hope that is clear.
Yes, sir. Yes, sir. Yes, sir.
So have we looked at GBPUSD?
No.
Yes.
We've not looked at GBPUSD.
Okay, we've not.
Okay. Euro USD. So let's look at GBPUSD before we end tonight's session. GBPUSD is the same bias. GBPUSD and what's it called? Euro USD are positively correlated. So if you look at the pattern we have on GBPUSD, similar to what we saw on Euro USD. So shift to market. Let's start with the weekly. Okay, so you can see the pattern we had there similar to what we saw. This was a resistance, down support. So I had a resistance here. It became a support. Okay, so price is currently inside this zone, this demand zone. Okay, now after the formation of this candle, it's likely a fair value gap was created on a lower time frame. Let's see daily. And that could be the reason for the pullback. This is the daily. Let's go to 4 hour. So you can see the fair value gap that was created on 4 hour. See this fair value gap. That could be the reason for the pullback. That could be the reason for the pullback. You can see that. And on 4 hour, this is the most recent range on 4 hour. You apply a Fibonacci on this swing low. You apply a Fibonacci from this swing low to this swing high. It's obvious that price is at what? Extreme discount. Extreme discount.
Boss, I don't know what's happening. I don't know if it is from my end. You are your sound's very faint. Honestly,
Mr. Evans.
I don't know. Oh,
Yes,
that's
it's not too clear, but I have to strain my ears.
Boss, streaming of ear to ear, not everyone can stream ear.
It's not his fault. It's from the network. He has tried. It should be from the network.
How is it now? Is it better?
Just go ahead. Just go ahead. Let's. At least it's the last one. Let's just be here.
How is it now? Is it better?
Yes, a little better.
That's because others will need to watch this, you know.
That's just my concern. Others people will need to listen to this recorded section, and then if they can't hear, that's to see the effort is a wasted effort now.
How is it? Is it better now?
Yes, currently it's better now with the current sound.
It's better now. Let me try this.
Yes.
How is it now?
Yes.
Drop a comment. Drop a comment.
Very okay. Very okay.
Is it better?
Yes.
Is the sound better now?
Yes.
Very okay. Very okay.
Very okay.
All right. Okay. So, okay, let's move on. So as you can see, we have, okay, price is currently at extreme discounts. Okay, it's currently at extreme discount. So all we need to do is wait for a shift in market structure or wait for price to close above this fair value gap, which is the high. This is the high of the fair value gap. Wait for a candle to close above it and also go to 1 hour, 15 minutes time frame, identify a shift in market structure. So the shift in market structure on 1 hour, 15 minutes is going to occur at this point. Okay, this is where the shift in market structure will occur. So same thing we did on Euro USD. Let's apply our Fibonacci from this swing high to this swing low. Once the price pull back to this area, this is where we'll consider buying. Okay, this is where you should consider buying GU. And if you want to jump in, let's assume price just continue going up from this current market price. So you are entering from this point. Yeah, okay, this is the high. So what you need to do, calculate the risk. This is 72 pip. The risk is very high. Now, if you decide you want to buy from this point, you should reduce your lot size. So let's say I would be risking $50 on this trade, $50 on this trade. So, and the risk here will be, let's say 75 pips, okay? So I want to risk $50. I'm going to risk $25 on this trade, okay? I'm going to risk $25. So on this first trade, what will be my lot size? $25, that should be around 0.03. Yeah, 0.03 lot size will give me about maybe $22 or $23. Okay, so I will take a buy above this area. Then if price decides to pull back to fill this, to discount before going bullish, then I will take more trade. I still have $25 to risk, right? So I will risk the remaining $25 when price pulls back to this area. I hope you get that.
Yes.
I hope you get that. But if price pulls back to this area, okay, before going bullish, I would risk the $50 on that trade. I'm going to risk $50 on that trade if price pulls back to this area before I buy. So SL is supposed to be at this level. This is about 20 pips. Remember what I did on Euro USD. So if the risk, this is where I should have entered. Okay, so I would have risked 73 pips on this trade. So if I decide to buy from this point, I will take that 70 pip risk. Okay, 70 pip risk. That's the risk I will still take on this trade. So my lot size here will be how many? Let's say I'm risking 70. Lot size here will be 0.05. Okay, yeah, let's say 0.05. Okay, 0.05. Then when market breaks this high, I will risk the remaining $25. Okay, I will risk the remaining $25. So if I'm taking 0.05 here, it means 0.03. Yeah. At this point also, I will take 0.03 risk. Are you getting me?
Yeah.
I hope you're getting me.
Yes.
I hope you're getting me. So that's my take on GU. My bias for GU this coming week is buy. EU, buy. UJ, sell. Gold, buy. Okay? So that will be all for tonight's session. I want to appreciate you all for your participation, Mr. Joseph, Mr. Jesu Tofumi, and Mr. Evans. I really appreciate you all. Okay. So our next class will be on maybe on Tuesday. On Tuesday.
Okay.
Tuesday. Remember, the classes now holds in the evening. In the evening, I believe it's convenient for you all. Okay, evening by 10 p.m. 10 p.m. We meet on Tuesday, 10 p.m. Okay. I really appreciate you guys. You guys are motivating me. You guys are motivating me. I really appreciate you guys.
Thank you, sir. I appreciate
you
it.
guys. If you have any question, just drop it on the WhatsApp group. I also want to announce to you guys that Cabana Capital is offering 35% bonus. If you make a deposit above $100, you get 35% bonus, and that bonus is tradable. What does that mean? So let's say you deposit $100 and you get $35 bonus. If you blow your $100 account, your capital, you can still trade with the $35 bonus. That is why it is called tradable bonus. Okay. Now that is just to increase your equity, right? The bonus is just to increase your equity. Now, when it comes to withdrawal, you have you can withdraw every profit you make on your account. But let's say you deposit $100, you get that 5% bonus, and let's say you make a profit of $100. You can only withdraw the $100. Okay, you can only withdraw the $100. If you withdraw $101, the $35 tradable bonus will be deducted. You have access to your profit, okay, but you cannot withdraw more than the profit, as in now withdrawing into your capital. Are you getting me? That's the condition. That's the terms and condition. So you have access to the $35. If you blow your capital, I know none of you can blow your $100 deposit unless you are greedy. You don't apply proper risk and money management. So the $35 is just to help increase your equity. And if you blow your account, you can still trade with the $35. And with that $35, you can make profits, recover your $100, make more money, and you'll be able to withdraw. So I think that's good news for you guys. All right.
Yes, sir.
So once more, I want to appreciate you guys for your participation. Do have a wonderful night.
Thank you, sir. Good night.